There are so many different types of charts in Forex, it can be quite hard to know which one to use. So in this video, we'll be discussing each of the different types of charts most commonly used, and we'll be listing their advantages and their disadvantages. The first type of chart we'll be looking at is the bar chart, and what the bar chart shows you is the price action within a given period of time. So let's look at this bar for example. What this shows you is the price action within 5 minutes, as this is a 5-minute chart. When you break down the bar, you can understand that on the left this is the opening price, and on the right is the closing price. Down here is the lowest price reached within this time period, and up here is the highest price reached within this time period. The vertical line shows the price range within a given period. This is really important when looking for price fluctuations, as a larger vertical line shows that there's more fluctuations in price, which basically means there's more volatility. And when there's a smaller bar, that means there is less fluctuation in price, and so less volatility. The benefits of using the bar chart is you get to see the price action very quickly within a given period. But the downside to using bar charts is that their design is now outdated when compared to candlesticks. The next type of chart we will be looking at are line charts. And the two main benefits of using line charts is their simplicity and to quickly see the general price movement of a currency pair. In a line chart, the line connects relevant prices, allowing you to quickly analyze the market. There are variations to the very simple line chart, and these variations are to do with the values that are connected by the line. Some line charts use the open value, some use the high value, some use the low value, and some use the close value. Line charts are very useful for identifying trends as well as drawing support and resistance levels. However, line charts don't allow you to see market noise, which is the fluctuation in price within each time segment. The next type of chart we'll be looking at is candlestick charts. This is probably the most recognizable chart when it comes to trading Forex, but let's understand what it all means. Let's use this candlestick as an example. What you can see here is the body that's colored here. And so what this shows you is the price action between opening and closing prices. If it's red, it's bearish, and if it's green, it's bullish. As you can see, there are different real body lengths. And what the real body lengths show you is the amount of price action during the time which the candlestick is formed. Candlesticks also have a line above and below the real body, and these are called shadows. And what these shadows represent is the upper shadow represents the highest price reached within this time period, and the lower shadow represents the lowest price reached within this time period. And these shadows can help form candlesticks that will help you have a better understanding about future price movement. For example, this candlestick is called the shooting star, and what this tells you is that a bearish move will follow, but we will get onto this in a later video. Candlesticks are a great place to start for beginners if they want to understand how to start doing Forex chart analysis. They are very easy to use and very easy to interpret, as the candlesticks can help you visualize bullish or bearish sentiment by displaying bodies using different colors. There are also candlestick patterns which can help you understand the market and easily help you identify market turning points, as you can quickly see reversals from an uptrend to a downtrend or a downtrend to an uptrend, and we will cover this in a later video. The next type of chart we'll be looking at is called Heikin Ashi, and most traders would consider the Heikin Ashi chart better than candlestick charts, as Heikin Ashi charts remove the noise from candlesticks and they look and behave like moving averages. They are used to determine the relative strength of a trend and to pinpoint key turning points in price behavior. Heikin Ashi charts use a mathematical formula to average the open, low, high, and close prices for the current and previous candlesticks using no less than 4 different criteria. As you can see, Heikin Ashi charts are very smooth, and they will allow traders to make a very good decision when. Thank you for watching. I hope you enjoyed the video. Like and subscribe for more content like this. We'll be taking an in-depth look at how to use these charts in our next video. Before you invest in something, invest in time to understand it.